Welcome to This Explainer. Today, we're putting on our professional equity analyst hats to conduct a rigorous stock valuation. We're going to put REZI Technologies, ticker symbol REZI, through what I like to call the analyst's gauntlet. Our goal here is totally clear. We want to uncover this company's true intrinsic value using strict, absolute, relative, and asset-based valuation models, pulling all our data straight from their financial metrics. Let's just anchor our analysis right off the bat. REZI's current stock price is sitting at exactly $40.14. But, that isn't just a static number. That actually represents a massive, and I mean massive, 135% run-up from its 52-week low of $17.07. The market has been incredibly enthusiastic, rewarding the stock with some serious upward momentum. But here's the thing. As analysts, we don't just blindly follow the crowd, right? We follow the math. So this brings us to the central mystery of our explainer today. Is it actually worth it? Does the underlying fundamental data actually support this $40+ valuation, or is the market wildly overestimating what it's really worth? Well, we're going to crunch the numbers and find out. Here's our quick roadmap for the gauntlet. First, the analyst's challenge. Second, the absolute valuation gauntlet. Third, relative peer pricing. Fourth, asset-based floor value. And finally, our final intrinsic value synthesis. Okay, jumping into section 1, the analyst's challenge, where we navigate the data paradox. And wow, this slide brilliantly illustrates the paradox we're dealing with here. Look on the left. You see these absolutely surging market returns. The trailing 12-month price compound annual growth rate is an astonishing 134.89%. But then look at the right side. The massive fundamental obstacle staring right back at us is a trailing 12-month free cash flow of negative $1.253 billion. To put that in perspective, the stock is flying incredibly high, but the underlying business is literally bleeding cash. Let's move to section 2, the absolute valuation gauntlet, looking at discounted cash flow, dividends, and residual income. So in absolute valuation, we really only care about the hard cash the business can theoretically put directly into an investor's pocket. But before we do that math, we have to set our discount rate. This is the WACC, or weighted average cost of capital. Basically, it's the absolute minimum return a company must earn to satisfy its investors. Now, because an explicit WACC isn't provided in our source data, we're acting as prudent analysts here and assuming an industry standard of 8 to 10%, just to stress test these upcoming models. First up in our absolute gauntlet is the dividend discount model, or DDM. This model tries to value a stock based on the present value of expected future dividends. Well, actually, scratch that. This one instantly short circuits. When we check the yield, the trailing 12-month dividend growth is exactly 0%. REZI pays 0 dividends, so model failed. We got to move on. Next up is the absolute gold standard, the discounted cash flow, or DCF model, where we project free cash flows and discount them back to present value. But check out the table. Because that trailing 12-month free cash flow is negative $1.25 billion, the source data literally lists the fair value as NA. You just can't reliably discount massive negative cash flows to find a positive equity value. It breaks the math. So we're forced to rely on an alternative absolute valuation from the data, an EPS, or earnings per share projection model. And based on those earnings projections, the absolute fair value sits at a mere $4.46 per share. Just to be totally thorough, we also attempt a residual income model. This starts with the current book value of equity and then adds the present value of future residual income, which is just net income minus an equity charge. But surprise, surprise, this model fractures under the pressure here too. Why? Because REZ's trailing 12-month net income is sitting at negative $578 million. Without positive net income, there's absolutely no residual income to add. All right, section 3, relative peer pricing, where we compare REZI to the broader market. Since our absolute model severely struggled with all that negative cash flow and net income, we have to pivot. We need to see how the broader market values REZI. Now, I want to explicitly state our assumptions here. The source documents don't list direct, explicit competitors. So, as your analyst today, we are using the provided valuation multiples to gauge the company's implied industry standing against standard market baselines. We're going to focus primarily on forward PE and EV to EBITDA. Now, what's really fascinating about this slide is the relative valuation matrix. Despite those brutal negative trailing earnings, the forward-looking metrics paint a much more optimistic picture. REZI is trading at a forward PE of just 13.35 and an enterprise value to EBITDA of 10.49. Even the price-to-sales ratio of 0.81 suggests you're paying less than a single dollar for every dollar of sales. Relatively speaking, the market is clearly pricing in a huge turnaround in profitability that our historical absolute models just can't see. Moving into Section 4, Asset-Based Floor Value. Basically, what are the parts worth? So, if the earnings are currently negative, can we at least calculate a fundamental floor value based purely on the balance sheet? Take a look at this specific number we extracted straight from the source data, 1.02. That's the enterprise value to assets ratio. It literally means the company's entire enterprise value is almost exactly identical to its total assets. Let's break down the logic of this net asset value a bit more. That 1.02 ratio indicates very strong asset backing for the company as a whole. And the debt-to-equity ratio of 1.09, that shows moderate, completely manageable leverage. However, look at the price-to-book ratio. It's 2.06. This tells us that while the overall enterprise is backed by hard assets, the specific stock price, the equity, is currently trading at more than double its book value. The net asset value per share heavily trails that $40 market price. And finally, Section 5, Final Intrinsic Value Synthesis, where we bring it all together. We've run the gauntlet, folks. We've looked at absolute cash, market multiples, and underlying assets. Here is our synthesis table, detailing the strengths and weaknesses of each model's result. Notice how we have to weight relative pricing the highest in this specific scenario. Why? Because REZI's massive negative cash flows, remember that negative $1.25 billion, severely break the reliability of our absolute valuation models. The DDM gets a 0 weight. The DCF based on EPS gives us an absolute value of $4.46, but its reliability is super low right now due to the current unprofitability. The asset-based model gives us a medium reliability floor, confirming we're paying a premium to book value. The big takeaway? The market is clearly trading REZI based on relative forward expectations, not its current cash realities. So, the most crucial point of this whole explainer is this staggering metric right here. A negative 800.76% margin of safety based on earnings per share. I mean, wow. This illustrates a massive, undeniable disconnect between the stock's current trading price of $40 and its projected EPS fair value of just $4.46. Investors are clearly paying a massive premium for future potential, pretty much completely ignoring historical absolute value. And that brings us to the ultimate question you have to ask yourself. You've seen the data, you've walked through the models with me. With the stock bouncing off a 52-week low of $17 to completely soar past $40, yet possessing an absolute EPS fair value of just $4.46, is the margin of safety wide enough for your portfolio? It's a classic, fascinating battle between market momentum and fundamental valuation. Thanks so much for joining me on this explainer, and as always, keep questioning the data.